Welcome to one of the most exciting topics in business. Have you ever wondered how the stock market actually works? Why do prices rise and fall every day? Who sets the price of a share? And what does all this have to do with you, even if you've never bought a share before? In this video, we explain how the stock market came about, how exactly trading works, why share prices fluctuate, what the difference is between shares, indices, and other securities, and which myths about the stock market are simply not true. Stay tuned. You'll see the financial world with completely different eyes afterwards. Before we understand how the stock market works today, let's take a brief look back. The idea behind the stock exchange is not new. Its origins lie in the Middle Ages, in the 14th century to be precise. Back then, merchants met in European trading cities such as Bruges or Antwerp to trade goods and bills of exchange. These meetings often took place in inns, including the house of the Van der Beurs family in Bruges. This is where the name Beurs comes from. The first real stock exchange, as we know it today, was established in Amsterdam in 1602. Shares in the United East India Company were traded there. It was the first stock exchange in the world. Why was this so revolutionary? Quite simply, instead of financing a large project alone, many people were able to buy shares and participate. That was the starting signal for the modern capital market. From then on, the idea spread. Today, there are stock exchanges in almost every country in the world. The best known are the New York Stock Exchange, NYSE, the Nasdaq, the Frankfurt Stock Exchange, the London Stock Exchange, the Tokyo Stock Exchange, and many others. Okay, but what exactly is the stock exchange? The stock exchange is a marketplace for securities. This means that shares, bonds, commodities, options, and many other financial products are bought and sold here. In the past, traders used to meet in person. This is called face-to-face trading. Today, most trading is done digitally. Trading takes place on computerized exchanges. Orders are executed in milliseconds. The stock exchange fulfills three important tasks. Firstly, it brings buyers and sellers together. If you want to sell shares, you need someone who wants to buy. The stock exchange organizes this. Secondly, it ensures fair prices. The price of a share is determined by supply and demand in real time. And thirdly, it makes trading secure and transparent. There are clear rules, supervisory authorities, and documentation to ensure that everything remains comprehensible. The stock exchange is therefore not just a place for gamblers and speculators, but a central component of the economy. Let's imagine you want to buy a share. How does that work? Step 1. You place a buy order, for example via your custody account at a bank or via a trading app. Step 2. Your order is forwarded to the stock exchange. There it meets sellers who want to sell the same share. Step 3. A computer or stockbroker ensures that supply and demand come together. When buyers and sellers agree on a price, a so-called price is created. The whole thing happens in seconds, sometimes even in milliseconds. There are different types of orders. The limit order. You say at what price you want to buy or sell. The market order. You buy or sell immediately at the current market price. And the stop-loss order. You specify the price at which you want to sell automatically in order to limit losses. The price of a share is therefore not set by a company, but by the market, through supply and demand. This means, if many people want to buy a share, the price rises. If many sell, it falls. This is how the daily ups and downs on the stock market occur. There are more than just shares on the stock market. Here is an overview of the most important financial products. Firstly, shares. These are company shares. When you buy a share, you own a small part of the company. Secondly, bonds. These are debt securities. You lend money to the state or a company and receive interest. Thirdly, commodities, such as gold, silver, oil. These are traded on special commodity exchanges. Fourthly, derivatives, i.e. options, futures, and certificates. These are bets on the future of prices, more complicated, but very common. Fifthly, funds and ETFs. These are packages of many different shares or bonds, ideal for beginners to spread the risk. Cryptocurrencies such as Bitcoin are now also traded on special exchanges, although not on traditional stock exchanges. You may be asking yourself, why do prices fluctuate all the time? There are many reasons for this. One is economic data. When companies publish good figures, share prices rise. They fall when the figures are bad. Secondly, interest rates. When central banks raise interest rates, this can put pressure on the stock market. Also due to news and rumors. Even a tweet can move prices today. Elon Musk has proven this several times. Supply and demand also play a major role. If many people buy, prices rise. When many sell, they fall. Finally, psychology. Fear and greed play a major role. People often buy because everyone is buying or sell out of panic when prices fall. This is also known as market sentiment. The stock market, therefore, reacts not only to facts, but also to emotions. When you deal with the stock market, you will often hear certain terms. Here are a few of the most important ones. Bull. A bull stands for rising prices. The bull market is a market with positive sentiment. Bear. A bear stands for falling prices. A bear market is a longer phase of falling prices. Index. An index such as the DAX or the Dow Jones is a basket of different shares. It shows how the market as a whole is developing. Dividend. This is the portion of profit that a company pays out to shareholders. IPO. This is the initial public offering of a company, the moment when a company sells shares for the first time. The more you know these terms, the better you will understand stock market news and market analysis. Many people have misconceptions about the stock market. Here are a few typical myths. The stock market is just gambling. That's not true. Of course, there are speculators, but long-term investing has nothing to do with gambling. The stock market is only for the rich. Also wrong. Today, anyone can invest small amounts, thanks to ETFs or savings plans. You have to constantly monitor the markets. No. If you invest for the long term, you can sit back and wait. Only insiders win on the stock market. Insider trading is prohibited and is strictly prosecuted. Success on the stock market is based on knowledge, patience, and strategy. The stock market can be fascinating, but it also has its downsides. So-called speculative bubbles arise time and again. This happens when investors get caught up in hype and prices rise to unrealistic heights. At some point, the bubble bursts, and many people lose their money. A classic example is the tulip bubble of 1637 in the Netherlands. Back then, people paid crazy sums for tulip bulbs until the market collapsed. The dot-com bubble around the year 2000 was similar. Internet companies were extremely overvalued, even though many were not making any profits at all. When this came to light, the dreams of many investors were shattered. And then there was the financial crisis of 2008, triggered by the real estate market in the USA. Here, too, the market was overheated until the system collapsed. Another problem is market manipulation. Large investors can influence prices by deliberately creating sentiment or spreading rumors. The GameStop 2021 case is an example of how small investors turned the tables once and put hedge funds in trouble. This shows the stock market offers opportunities, but it is also susceptible to exaggerations and emotions. It is therefore important to keep a cool head at all times. Let's summarize. The stock market is much more than just a place where shares are bought and sold. It is the pulse of the economy. It helps companies to raise capital, and it allows you to make your money work for you. If you know the rules, you can profit from the stock market without having to speculate. Now I'm interested in your opinion. Have you had any points of contact with the stock market? Or do you have any questions on the subject? Let me know in the comments below. I look forward to hearing from you. If you liked the video, give me a like, share it with your friends, and subscribe to the channel for more financial knowledge. Thanks for watching. See you next time.